Imagine walking into your local bank on Monday morning, ready to buy gold like you've done before. And suddenly the bank says, "Sorry, that product doesn't exist anymore." Now imagine that happening, not at some tiny neighborhood bank, but at some of the biggest banks on the planet. Sounds like the opening scene of a financial thriller. Except it actually happened. Over the last few weeks, several major Chinese banks, including the world's largest commercial bank, have quietly shut down paper gold trading for everyday customers. The changes officially take effect around late July 2026, and while the headlines barely noticed, the timing has people asking one big question. Why would multiple banks all make the same move at nearly the same time? According to the official explanation, it's all about protecting regular investors. Gold prices have been on a roller coaster recently. Earlier this year, they surged to record highs before pulling back sharply. Plenty of investors got burned chasing the excitement, so banks say removing paper gold products is simply a way to reduce risk. But here's where things start getting interesting, because these banks aren't banning physical gold. If someone wants to walk in and buy actual gold bars or coins, they still can. The only thing disappearing is paper gold, the contracts, digital claims, and financial products linked to gold prices. And whenever governments or major financial institutions start separating real assets from paper promises, history tells us it's worth paying attention. Because this isn't the first time something like this has happened. In fact, to understand what's unfolding today, we need to travel back nearly 60 years, to a room inside the Bank of England, where something so unbelievable happened that the floor literally collapsed under the weight of stacked gold bars. No, that's not a movie scene. That actually happened. And the reason those vaults were overflowing with gold might explain why today's changes in China could matter far more than most people realize. Back after World War II, the global economy ran on a simple promise. Countries agreed to use the US dollar for international trade because America guaranteed that foreign governments could exchange their dollars for gold at a fixed rate of $35 per ounce. Simple. 1 ounce of gold, $35, anytime. That promise gave everyone confidence in the dollar. Holding dollars felt almost the same as holding gold itself. But there was one tiny problem. The US government started spending far more money than it was bringing in. Wars became expensive. Government programs expanded. America was financing its role as the world's superpower. And whenever governments spend beyond their income, they usually have two choices: raise taxes or create more money. You can probably guess which option was more popular. As more dollars entered circulation, the amount of gold sitting inside government vaults barely changed. Now imagine you're another country holding billions of US dollars. You'd probably start asking a very uncomfortable question. If there are way more dollars now, but the same amount of gold, is every dollar really back the way we were promised? If the supply of dollars keeps growing while the supply of gold stays almost the same, then that fixed price of $35 an ounce begins to look less believable. Countries started doing the obvious thing. Instead of holding paper dollars, they exchanged them for actual gold while they still could. And that's exactly what created one of history's biggest runs on gold. To stop gold prices from rising, the United States teamed up with several European countries in the early 1960s. Together, they created what's known as the London Gold Pool. Whenever market demand tried pushing gold above $35 an ounce, these central banks would simply sell gold from their own reserves. Think about that for a second. They weren't selling because they wanted to make money. They were selling because they wanted everyone to keep believing that the official price was still real. For a few years, it worked. Then cracks started showing. France decided the math no longer made sense. Instead of supporting the system, it quietly began exchanging its dollars for physical gold. Other countries noticed. They followed. Suddenly, everyone wanted the metal before somebody else emptied the vault first. Then came March 1968. Normally, the London Gold Pool sold only a few tons of gold in an average week to stabilize prices. But during one extraordinary trading day, demand exploded. Around 100 tons of gold left the vaults in just 24 hours. By the end of that chaotic week, roughly 1,000 tons had been sold, trying to defend the official price. That was also the week workers inside the Bank of England watched the weighing room literally buckle under the weight of stacked gold bars, arriving faster than they could process them. Soon after, officials shut London's gold market temporarily. When trading finally resumed, the old system had effectively collapsed. From that point forward, two different prices existed. One was the official government price. The other was the price people actually paid in the open market for real physical gold. And just a few years later, in 1971, President Nixon ended the dollar's convertibility into gold altogether. The old system was over. So after hearing all of that, you might be wondering, okay, history is interesting, but what does any of this have to do with today? Everything. Because the system that exists today is very different from what most people imagine. Here's a quick question. When someone says they bought gold through a bank or an investment app, did a truck actually deliver a gold bar to their house? Of course not. In most cases, what they really bought is a paper claim tied to the price of gold. Think of it like getting a claim ticket at a coat check. The ticket says your jacket is waiting for you, but imagine if the venue secretly handed out 10 tickets for the exact same jacket. Everything looks perfectly fine, until everyone shows up to collect it at once. That's the basic concern many analysts have about today's paper gold market. Instead of moving physical gold every time someone buys or sells, financial institutions often trade contracts representing gold. Most investors never ask for delivery. They simply buy the contract, hope the price rises, then sell the contract back later for a profit. Since very few people request the actual metal, more contracts can exist than physical gold available to satisfy them. And that's where things become important. Markets determine prices through supply and demand. But what happens if the market believes there's far more gold available than actually exists? The perceived supply becomes much larger. And when supply appears larger, prices tend to stay lower than they otherwise might. Now, nobody publicly knows the exact ratio between paper claims and real gold in global markets. That's one of the biggest mysteries. The world's benchmark gold price is largely influenced by trading in financial contracts, not by people loading gold bars into pickup trucks and driving away. So how could anyone tell if paper prices are drifting away from the value of physical metal? There are two clues. Watch for a gap between the price of paper contracts and the price people pay for actual physical metal. In a perfectly functioning market, those prices should stay nearly identical. But when confidence starts slipping, buyers often become willing to pay extra just to own the real thing. Earlier this year, physical silver briefly traded at a significant premium over paper silver in some markets. It wasn't because silver suddenly changed overnight. It was because buyers placed more value on having the metal itself than holding a financial promise linked to it. Gold hasn't shown the same kind of dramatic separation yet. But history reminds us that these differences don't always appear gradually. Sometimes everything looks perfectly normal, until suddenly it doesn't. The second clue might be even more revealing. Instead of listening to what major financial institutions say, watch what they're actually doing, because actions usually tell a much more interesting story than press releases ever will. China isn't telling people to stop buying gold. In fact, if someone wants to buy physical gold, they still can. What's changing is the ability for everyday investors to trade paper gold products through several major banks. That distinction matters, because at almost the same time, China has continued expanding a gold market that works very differently from the traditional system used in London and New York. On the Shanghai Gold Exchange, physical delivery plays a much bigger role. When gold changes hands, the expectation is that real metal backs the transaction. The focus isn't simply on trading contracts all day long, it's designed to connect buyers and sellers through actual gold. Supporters of this approach argue that a market built around physical delivery could provide a clearer picture of genuine supply and demand. Economists often call this price discovery, allowing buyers and sellers to determine value with fewer layers of financial products sitting in between. But China didn't stop there. For international investors, Hong Kong is becoming an increasingly important gateway. Since trading directly inside mainland China isn't always simple for overseas participants, Hong Kong provides a bridge between global investors and China's gold market. And then there's another detail that has caught plenty of attention. Hong Kong has been dramatically increasing its capacity to store physical gold. Think about that for a moment. Paper contracts don't need warehouses. Digital promises don't require massive vaults. Only real gold needs storage. So whenever billions are being invested into expanding vault capacity, it's reasonable to ask why that infrastructure is being built. Is it simply preparation for higher demand, or is it part of a much bigger long-term strategy? Nobody can answer that with certainty today, but it's certainly raising eyebrows across global financial markets. Now let's look at another trend. Central banks around the world have continued adding gold to their reserves at an unusually strong pace. According to industry data, official sector gold purchases have remained historically high over recent years. At the same time, many central banks have been reducing portions of their holdings in U.S. Treasury securities while increasing allocations to gold. Again, actions often speak louder than headlines. If institutions responsible for managing national reserves are steadily accumulating physical gold, it's understandable why investors are paying attention. Now let's bring this closer to home. Think about everyday life: housing, cars, groceries, gasoline. Over the past several decades, prices measured in dollars have climbed dramatically. Many people simply call that inflation. But when those same items are compared against gold, the picture looks very different. The point isn't that everything suddenly became more valuable. It's that purchasing power changes depending on what you're measuring against. That's one of the biggest reasons gold continues to attract long-term attention from investors around the world. Now, does this automatically mean gold prices are about to skyrocket? No. Nobody knows exactly what happens next. Financial markets are influenced by countless factors, and predicting the future with certainty is impossible. But here's what many analysts will be watching over the coming months. First, does a noticeable gap begin appearing between the price of paper gold and the cost of buying physical gold? If that gap grows, it could signal changing confidence in paper markets. Second, do central banks continue increasing their gold reserves while reducing exposure to other reserve assets? If that trend continues, it may tell us how major institutions are positioning themselves for the future. History doesn't always repeat itself. Sometimes it rhymes. Nearly 60 years ago, a financial system built on confidence eventually reached its breaking point. Today, some observers believe we're witnessing the early stages of another major shift, one driven not by dramatic headlines, but by quiet decisions happening behind the scenes. Whether this turns into one of the biggest financial stories of the decade, or simply becomes another chapter in the history of global markets, only time will tell. But one thing is certain: when the world's largest economies start changing how they handle gold, it's worth paying attention. So here's the question for you. Do you think gold is entering a completely new era, or is the market simply adapting to changing global conditions? Let me know your thoughts in the comments. And if you enjoyed this breakdown, don't forget to like the video, subscribe to the channel, and share it with someone who loves following major economic shifts. Thanks for watching, and I'll see you in the next one.